Bollinger Bands. Now tonight I'm going to share with you a couple prepared presentations. If you wish to see these little prepared presentations, you can go to YouTube and look for the channel called Forex and CFD Education, and then look for the playlist for Bollinger Bands. Also, the ones on the ETX platform that we're going to show you tonight, you can find by going to YouTube and then looking for ETX Capital. I've also given you a handout. If you look on your screen right now, you see this little handout with a download button that's called the ETX Capital Technical Indicators. It's a short little 10-page explanation on some of the most respected indicators out there. It's a good reference guide. Now, it's only available during the live class, but if you don't download it, you can contact customer support and they'll give you a link. But just click on the download button, put it wherever whatever device you're using, even if it's a handheld. It's a small file, and then you can move it around later to use it at your convenience. Now, in tonight's class, I'm going to be using the term security. Although I might say Facebook, I might say the pound. I'm not specifically talking about any specific asset. It just gets very boring saying security, security, security over and over again. But we are talking about all publicly traded financial instruments in which an open market exists, or any asset that you're trading on the ETX platform in CFD format. So we're talking about it's all CFDs and all forex. Similarly, I intermix the terms investing and trading. Since all of you here are part of ETX, you're traders, and we know the difference between trading and investing. But I intermix the terms just because, again, it gets very, very boring saying trading, trading, trading. So we all understand that trading is a short-term process and investing is a different technique. And most investors don't use technical analysis at all. Now, one of the first questions that a trader asks me, whether they're new, whether they're experienced, whether or not, especially when we're doing seminars all over the world, and I start talking to a group of people, first thing they ask me is, how do I know what I should buy today? How do I know what I should sell today? How do I know what price an asset will be in an hour from now or tomorrow or next week? Well, wouldn't investing and trading be easy if we knew the answers to these questions? Well, the fact is, I don't have a Ouija board and I don't have a crystal ball, and neither does anybody else. Anybody else professing to tell you, do this, do that, and do that, you'll make money, is full of it. Okay. Nobody can tell you where an asset will be or what an asset is exactly going to do. What we want to do is we want to find high probability trading opportunities. And then we want to apply the best risk management and money management skills we can so that we can take advantage of the very successful trades and minimize our losses on the trades that go against us. So I think of all of these as filter systems. I look for a way to find an entry or an exit point, not an entry or exit, a buy or sell alert, a buy and sell signal, a buy or sell or transaction indicator that tells me there's an opportunity. Then I want to start putting other types of filters on this chart to determine, number one, is it a good trade? How much profit can I make from that trade? Does it have momentum? What I'm looking to do is throw all those trades in the trash can and not make them. I'm looking to filter them back, so each time I add another filter, it's going through a set of tests to say, okay, it's forgotten about. So technical analysis will help you filter out these trades. Now, it's important to realize that once we filter out these trades to only high probability potential opportunities. Because remember, the market always offers trades. There's always something to trade. There's endless amounts. It's not like you're walking down the street and you see, last pair of these on sale for half price, or you're going to try to beat, you're going to line up on Christmas Day outside of, Home Base or Asda and hope to get that TV, the 10 TVs they have at half price. This isn't it. The market has so many trading opportunities, we can't even find them all. So we need something that's going to help us alert to these opportunities. And if you subscribe to the theory, and I'm not going to make you subscribe to the theory, but I subscribe to the theory that the market is totally random. Price dictates everything, and nobody can understand what price is going to do, and it is random. If it's going to go up the next 10 minutes, it's going to go down. It's going to close higher, close lower. None of us know. It is totally random. And most of the time, almost all assets stay in this random movement. When the markets are moving in this random process, we can't really make any trades because then we're just kind of guessing. But there are times that the markets do, and they're very short periods of time, do come together and exhibit non-random behavior. And these are really uptrends and downtrends. But these are real trends, not just an asset is moving up or an asset is moving down, that is actually moving in a non-random manner that we can now predict what's going to happen before it goes back to its randomness. Now, one of the most popular indicators in all the world that helps us see a lot of these things and that has withstood the test of time and will give us alert signals such as transactional buy or sell signals, will also help us see when the market begins to trend, is Bollinger Bands. Now, Bollinger Bands was developed by a guy named John Bollinger, and hence Bollinger Bands. Now, the nice thing about, or the rare thing about Bollinger Bands is that John Bollinger is still active, and he still operates his Bollinger Band website. He still has classes and videos and everything. So after this webinar, if you want to go to www.bollingerband.com or go to YouTube and just look up Bollinger, and you'll see all of these videos from John Bollinger. You go to Bollinger Band's website, there's no money involved, and you can read and learn all about how he developed this, which I'm going to tell you, but his view. So you can actually learn directly from the horse's mouth. And this means that he has been testing his bands for 30, 40 years. So today, Bollinger Bands are so popular, they're automatically dropped on the chart. All you have to do is go to indicators, click on Bollinger Bands, and they're put on your charts for you. And there also is an abundance of information published on how to trade with Bollinger Bands. Much of it is discretionary in theory. It's someone's interpretation. It's a Bollinger Band strategy. Somebody telling you, do this, do that, and do this, or adjust your Bollinger Bands to do this and do that, and you'll get great trades. So the how to use Bollinger Band information usually pushes it back to the trader to interpret what the security price is doing relevant to the bands. And Bollinger Bands is a type of trading called a band or an envelope. It is one of the few indicators that is actually dropped on price chart directly over price. So let's go over to a live chart and let's see how this is done. So let me pop up a chart here for us. Okay, so we're looking at the current Euro US dollar chart in a 30-minute chart, only because this is my teaching chart. I'm not making any recommendations on the euro. I'm not discussing euro. This is the chart I teach from every class. This is the asset I use in a 30-minute chart. Period, Dan. Okay. So there's no recommendation. We're not analyzing the euro to make a trade at the moment. Now, the first thing Bollinger Bands does or needs is a 20-period moving average. And this is the gold line I have put on the charts right now. And I've colored it gold for no other reason. That's the color I selected for you to see it easier in class. And then Bollinger Bands takes a statistical calculation called a standard deviation, and those two standard deviations above and two standard deviations below the moving average line to create the upper and the lower band. Now you're going to ask me, okay, what is standard deviation? Okay, it's a very complex statistical mathematical calculation that is used by statisticians for lots of stuff, having not, it wasn't developed for the financial markets. So, as I said, Bollinger Bands puts the upper band and the lower band on the chart using the calculation of two standard deviations. So if you notice, if I use inputs here, we're using a 20-period moving average and two standard deviations. And whenever you click on Bollinger Bands, it's going to drop that on your chart with that. You can customize it after that, but then it's Barry's bands, Bill's bands, Brian's bands. It's no longer Bollinger Bands. So we use a 220 formula. Now, what we're concerned with are three lines on this chart: the upper band, the lower band, and the moving average band. The shape of this overall thingy here doesn't tell us anything. Sometimes it looks like a snake. Sometimes it looks like an alien. Sometimes it looks like a squiggly little thing, God knows what. It does all kinds of things when you look at it. Now, the width of this band does give us a piece of information. The wider the band, the more volatile the market is. The more contrite the band is, the lesser volatilities in the market. So that helps us off the bat for one important thing. When we know if markets are volatile or not, it helps us apply risk management. Because when markets are not volatile, we should be using a much smaller risk-reward calculation. And when markets are very volatile, we need to maybe increase our risk-reward percentage because of the market volatility. But it might also say, hey, filter out that trade. The markets are too volatile right now to make. The interpretation is left up to you. But it does give us this piece of information. But ultimately, what we're looking for is the relationship to the band and the price and the moving average. So before we can go on, we have to talk about the standard deviation, because you can't blindly use this indicator without understanding how it's derived. But once we explain standard deviation, you never have to do any calculations. You just, wouldn't you feel stupid if you're sitting there with a buddy and he says to you, well, I use Bollinger Bands and I changed my standard deviation to 2.5 and this does this, and you don't even know what he's talking about. He says, well, and you should know what the standard is, not the calculation. You should just know what it is. So let's go back and touch on that on my PowerPoint. And then we're going to go on and talk about how we would apply these to our trading. Now, Bollinger Bands can be applied in all financial markets, including equities, forex, commodities, and future. Bollinger Bands can be used in most time frames, from very short term to hourly, daily, weekly, and monthly. So what is quite unique about Bollinger Bands is it works very well in short-term time frames. Because there's a lot of indicators that I see people using that don't adjust well in short-term time frames. And therefore, they're using them for trading CFDs, and we're trading in very short time frames, looking at very small charts, and I'm looking at saying, well, that indicator doesn't do a good job in short-term time frame because it just gives you lots of false signals. And they don't even understand that why their indicator isn't a good indicator for CFD trading. Oh, my buddy told me I know CCI is the perfect indicator. It is for something else. So Bollinger Bands answers a question. Are prices high or low on a relative basis? By definition, price is high when it is at the upper band, and prices are low at the lower band. So that bit of information is incredibly valuable. It's even more powerful combined with other tools, such as indicators for confirmation. Now, interestingly, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, it's quite slow. Now, standard deviation, and I'm going to break this down and explain it to you. It is a mouthful, but again, once you understand it, we'll never have to talk about it again. Standard deviation is a measure of the dispersion of a set of data from its mean. Well, let me rephrase that sentence. Standard deviation is a measure of the dispersion of the closing prices from its moving average. It is calculated as the square root of the variance by determining the variation between each close to the moving average. If the data points are further from the moving average, there is a higher deviation within that set of data. Okay, kind of makes sense. So now I've redefined this standard deviation in terms that we understand in finance. So in its simplest form, the mean is simply the average of all the data points in a given set. In our case, it's all the data points in price action, or we're using all the closes, so it's the close. So investing, for example, you might want to know the average closing price for the last 20 periods. This can be obtained by adding the closing prices of each session and dividing by 20. Because markets are fickle at best, traders and analysts use moving average that adjust by each time segment and incorporate the most up-to-date data. So standard deviation is calculated based on the moving average. The distance of each moving point on the moving average is squared, summed, and averaged to find the variance. Or to put it another way, variance is derived by taking the moving average of the price, subtracting the average from each data point individually, and squaring each of those results. So if we took the close at say 1250 and took the average price, the 20 period moving average price, and it was 1249, we would take the difference of those. So that's taking each data point and subtracting the mean, the average, from the data point, and then we square it. So we took 1249 from 1250, we have 1. We square that, we still happen to have 1. And then we take another mean of these squares. So standard deviation is simply the square root of the variance. Okay, that being said, we're done with it. So Bollinger Bands has the base, or the center band, which is the 20 period moving average. It's got the upper band, which is spread above the moving average by a volatility measure known as standard deviation, and the default is 2 standard deviations. The lower band is the middle band less the same lower band. The middle band is just a minus that same volatility. So you have 2 standard deviations above, 2 standard deviations below the moving average, and each one is put on the chart with a dot, and then those dots are connected to form the upper and the lower band. Okay, so what we have when we do all that is exactly what you're looking at on the screen. Upper band, lower band, the 2 dark blue lines, and the moving average, or the middle band, which is a 20-period moving average. Okay, we got it. So we're done with the calculations. We're done with putting on our chart. Now, I've got through all this. What are we going to do with it? How is it going to help us? So, Bollinger Bands provides us several pieces of information. It gives us pattern recognition. It gives us reversal signals. It gives us buy and sell alerts, and it gives us trend analysis. So one of the most simplistic ways to use Bollinger Bands is looking for what we call the M and the W pattern. They're both the reverse of each other. A W is formed when price is coming off of a downtrend, and an M is formed when price is coming off of an uptrend. Now, it's similar to a head and shoulders, because just like a head and shoulders pattern, it takes a long time to develop. You're not going to see this pattern as it's emerging. You're not going to be able to predict this pattern. It takes a lot of time frames, but when it is fully unfolded, it's quite accurate. So price in a downtrend comes straight down the band and forms the first leg of the W. Won't even notice it here. Bounces off a bottom, which becomes a resistance level, and comes back up towards the upper band, and then reverses and comes back down to that band again, making the second bottom fairly equal to the previous first bottom. We will start to recognize it at this point. Okay. And this point is called the N, or the upside down N. Okay, it's the third leg, the completion of the third leg of the W or the M. When it hits this bottom and starts to move back up, when it crosses the moving average, that generates a buy signal or a buy alert. So it's telling you, okay, you have a long opportunity here, a buy opportunity. Let's start adding other filters to see if this trade is worthwhile making, or let's get rid of this trade because it's not worthwhile making. We can also use this to set our stop loss and our take profit level. And again, we have just the reverse, because remember, everything's out of reverse. So we have a W bottoms, and then we have the M formation with the tops. Very simplistic, but when you see it developing and you actually see it taking place, they're fairly reliable signals. So when the second peak of the N has been formed by the asset price action, it's time to start establishing a trading position. Now, we highly recommend combining the Bollinger Bands with the RSI indicator. It's a perfect match. There are 2 types of tops that you need to look at. So after a trend move, prices fail to reach the outer band. Okay. So when price is moving up and we have an asset that is trending up, As the price moves up or down, and I'm going to use a down trend right here, only because it's so easily visible. When price is moving down, it should stay near that outer band. At some point, it's going to fail to be able to reach that outer band. When it fails to break that out, to stay along that outer band or break through that outer band, it gets rejected. That's just simply telling you that this trend is over. When you see things like this, here prices moving along that band, and then we get a rejection here, we get a candle that can't close above that band, even though the high went above the band, and the next candle falls below, that price has been rejected, telling you this trend is in jeopardy, or the asset is losing momentum. So that is another way that we can use the bands. Now, during a consolidation period, price spikes into the outer band, which gets ejected immediately, or a reversal signal in a short direction. So during trends, the moving average holds very accurately, and a break of the moving average is usually a meaningful signal that the sentiment has shifted. So when prices bounce off the band and breaks that moving average line, because you find a lot of times price will break that or get rejected by the upper band, but won't fall below the moving average. Okay. It's only when it falls below the moving average do we have a meaningful shift. Furthermore, the average can be used as a trade exit signal, where a trader does not close his existing positions unless price has broken the moving average. So in other words, if we're in a trade and price is moving up the bands, even though it gets rejected, we still don't close our position until price breaks that moving average on the band. So as you can see here in the chart, we have price moving down. It gets rejected by the outer band, moves back up. At this point, it crosses that moving average. So we know that this downtrend is over. Okay. We can see price. Now, if we had also at this point waited for a signal to buy, and that would have occurred when when price finally broke through the band, we could have bought in this area, and we could have stayed in this trade because look, even though price got rejected, it never went below the moving average, and we could have stayed in this trade all the way up to here. We again see prices rejected by the upper band, and at this point, this is where we would have been exiting that trade. So we would have made our profit between here and here, which could have been a nice little set of pips moving along that trade. So while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or downside, it's important to use the bands to also set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or the volatility, with narrower risk reward during lower volatility and wider risk reward during higher volatility. So first I want to take you over and show you how you would put the indicators on your charts on the ETX platform. And then we're going to go over and take a look at how we would actually apply these in real trading scenarios. So first, let me pop up this little presentation on the ETX platform. So in contrast to most other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use Bollinger Bands to analyze the strength of trends and get a lot of important information this way. And this is one of the most important reasons we use Bollinger Bands. And let me show you how we would set the Bollinger Bands up, how we would set up, once we get them set up, how we would calculate our entry point, and how do we use the Bollinger Bands for our stop loss.
To the live market and take a look at the pound dollar on a daily chart to illustrate how we can trade using Bollinger Bands. The upper and lower bands represent two standard deviations away from the market, and the middle band is based on a simple moving average. There are many combinations that one can use in terms of the Bollinger Bands settings. However, the default and most common settings used are a period of 20 with a deviation of 2. Bollinger Bands can be used in ranging or choppy markets, that is, during times of consolidation like here, and also in trending markets. Therefore, this tool can be used by scalpers, day traders, and even long-term traders. Let's firstly take a look at how we can trade these bands in tight ranging conditions. As you can see, the market is ranging at this highlighted section. Note that price bounced between the upper and lower bands whilst it is ranging. Note that in this example, the range is small, therefore opportunities arise for both longs and shorts to be undertaken. A strategy can simply be followed by taking a short at this point. Once the price hits the upper band, placing a stop loss above the upper band here, and a profit target may be placed at the bottom band here. Once the lower band has been hit, the sell trade is closed. However, an opportunity to go long or buy arises. A buy can be executed here with a stop loss below the lower band and a profit target set at the point where the price hits the upper band. As you can see from these examples here, there were multiple trades to take both long and short. Another way to trade with Bollinger Bands is to focus on contraction and expansion. In simple terms, when the market ranges in a tight area or consolidates, it's known as contraction. Generally, what occurs in trading is when the market contracts like this, a breakout tends to follow. This is known as an expansion in the market. As you can see, the market had contracted here, then dynamically expanded to the upside, creating an uptrend. Traders can employ this strategy when trading with these bands. Traders can enter a long position once the market has broken out of the range at this point, highlighting a potential move higher. Using various tools to execute the buy once they have recognized at a point that the trade might trade higher can help determine the entry. Basic tools such as previous support as leverage or even trend line breaks can help to determine the buy. A stop to be placed below the entry at a point of tolerance, and a profit target measured by the range of the contracted area or potentially a break back below the middle band. Let's take a look at a short example. This is the ranging zone with potential for trades within the contracting period. Once the price clearly breaks out and expands to the downside, a sell can be executed here, for example, or even here. Once the direction has been determined, in this case, to trade a sell or to go short, the entry and exit points must be managed applying a sound risk management ratio. This expansion strategy can be traded on many time frames. Let's take a look at another strategy designed to use Bollinger Bands. One of the most difficult aspects of trading is to determine the trend. In this case, we will use a certain technique with the bands to help us determine the trend. Firstly, this setup requires patience and discipline, as the bands will tell us which way we are trading, either long or short. Using candlesticks for this technique is preferred, as you can see the closing price better than any other type of chart. An understanding of price support and resistance is critical for the entry, so please visit the support and resistance modules if you haven't done so already. Let's start with buys or longs. Step 1. We need the candle to clearly close above the upper Bollinger Band line. For instance, like here. The closing price has closed above the upper band line. Please note here, if you look closely, the closing price of these candles have not closed above the upper band. Only their wicks have gone above the band, but the actual candles have closed below the upper band. So this occurring is critical, as the part of the first criteria of the trade has been met. Once we clearly see that the green candle has closed above the upper band, we must ensure that when this occurred, that a new high was also generated. For example, when the candle closed above the upper band, we also had price generate a new high. This is critical, as this part of the setup defines the direction of the trade, and that is to go long once these two elements of the trade have been met. Just to repeat that step one more time. Once the candle closes above the upper band, we must ensure that in the process a new high has also been generated. Step 2 is to look for.
So as you can see, Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buy and sell balances, and potential trend shifts, as well as give you entry and exit points, stop loss, and take profit levels. Together with the moving average and the RSI, Bollinger Bands makes for a great foundation for a trading strategy. And on that note, I'm going to say goodnight to everybody. Thank you very much, and try putting Bollinger Bands on your charts on the ETX platform, okay? And just watch what happens. You don't have to use it to make any trading decisions. Bollinger Bands is a very visual indicator. You'll be able to see exactly what's happening by watching price move within the bands. So thank you very much for joining us, and we'll talk to you again next week. Bye now.